Hey, welcome to The Explainer. So, if you're an investor in the Indian stock market, you've probably been feeling the pain these last couple of months. The big question on everyone's mind is why is this happening and when is it going to stop? Let's get into it.
You know that feeling, right? You open up your app in the morning, hoping to see a sea of green. But by the end of the day, it's all red, again. You see a little dip and you think, okay, maybe this is a good time to buy. But then that dip just keeps on dipping. Honestly, this whole thing feels less like a simple market correction and well, more like a full-blown escape. And when I say escape, I mean it. Just look at this number. In the last 2 months alone, foreign institutional investors, we'll call them FIIs, have yanked out a jaw-dropping 1,50,000 crore rupees from the Indian market. To give you some perspective, that is a massive, massive amount of money to vanish in just 60 days.
So, what is the real story here? Well, that's what we're going to break down. First, we'll dig into this great investor escape. Then, we'll get into the specifics of why they're selling. After that, we're going to meet the unsung hero that's stopping a complete crash. And finally, we'll look at the big picture, the long-term outlook. Okay, let's kick things off with part one, the great investor escape. It's time to really understand this huge flight of foreign cash. So first up, who exactly are these FIIs? Well, think of them as huge overseas investment funds. And here's the most important thing you need to understand about them. They are not emotional. They couldn't care less about news headlines or local gossip. They run on cold, hard logic, asking just two questions. What is the price and what is the value? That is it. And that simple logic brings us straight to part two. Why are these super rational investors selling off their Indian stocks? Let's unpack the three main reasons they're making this call. All right, reason number one, and this is the big one. From a global investor's point of view, the Indian market has just gotten too expensive for the kind of returns it's giving back right now. And hey, the numbers don't lie. India's main index has returned a pretty weak 1.9% recently. I mean, that makes it one of the worst performers on the world stage. Now, compare that. Investors could have put their money in Japan and made over 22%, or gone to Brazil and made a whopping 38%. If you're managing a global fund, that's a no-brainer.
Let me make this even easier with a simple analogy. Imagine you're buying a jacket, the exact same jacket. In India, it costs you 220 rupees, but you could fly over to China and get it for 150, or even go to Brazil and grab it for just 100. Now, if you're a big company buying thousands of these jackets, where are you going to go? Exactly, you're going to Brazil or China. That's kind of what the price to earnings, or PE ratio, tells us. India's PE is high, just like that expensive jacket, meaning investors are paying a much higher price for every single rupee of a company's profits.
But wait, it's not just that the stocks are expensive. There's another huge problem that's eating away at investor profits. And that takes us to reason number two, the currency crisis. For the first time in history, the Indian rupee has crossed the 90 mark against the US dollar, hitting a new record low. Now, for these foreign investors who do all their accounting in dollars, this is a massive, flashing red light. Here's the simple math that they're all doing in their heads. Say an FII makes a nice 5% profit on their Indian stocks. Sounds great, right? But if the rupee also falls by 5% against the dollar while they're holding those stocks, guess what their net profit is? Zero. Nothing. The falling rupee can completely wipe out their gains. So to avoid that risk, they're just getting out. Okay, so we know the money's leaving India because it's expensive and the currency is risky. But where is all that cash actually going? Well, that brings us to reason number three. India is currently caught in what you could call a US-China sandwich. So here's how this sandwich works. On one slice of bread, you've got the USA, which is like a safe haven. Investors can just park their money in US government bonds and get a practically guaranteed 5% return. Super safe. On the other slice, you've got China. For investors who are willing to take on more risk, China's market is looking undervalued right now, which means the stocks are cheap. So the FAIIs have a simple formula: sell expensive in India and go buy cheap in China. Now, you'd think with 1.5 lakh crore rupees being pulled out, the market would be in an absolute freefall, right? Like a 20, even 30% crash wouldn't be out of the question. But that hasn't happened. So who is the unsung hero that's holding up the entire market? What's happening is actually a fascinating story. It's a tale of two completely different types of investors.
On one side, you've got the foreign investors just smashing that sell button like there's no tomorrow. But on the other side, you have our own domestic Indian investors who are calmly and confidently pressing buy, soaking up all that selling pressure.
And who are these domestic heroes? Well, it's millions of regular retail investors, people just like you and me, who are consistently putting money into the market every month through our systematic investment plans, our SIPs. This steady stream of cash has basically turned into the market's giant shock absorber, cushioning the fall and stopping a total collapse. Okay, so this brings us to our final and maybe most important section, the long-term outlook. Is this huge sell-off a permanent breakup between foreign investors in India, or is this just a short little honeymoon in another country?
You know, history gives us a really clear answer here. We have seen this exact movie play out before. Remember 2008? During the global financial crisis, FIIs ran for the exit, only to come rushing back in 2009 for a massive 80% rally. And then again, during the COVID crash in 2020, they fled and then came right back in 2021 to push the market to all-time highs. The pattern is crystal clear. They leave when things are uncertain, and they come back for the profits.
And why do they always come back? Because you just can't deny India's fundamental strengths. We are the world's fastest-growing large economy. We have a massive and growing middle class with incredible spending power. Giants like Apple and Samsung are making India their global manufacturing hub. Our startup scene is absolutely booming, and we're even managing to keep inflation in check with things like discounted oil. The long-term India story is just incredibly strong.
So, if there's one thing to take away from all this, it's this. FIIs are not breaking up with India. They are traders, plain and simple. They've just left for a temporary honeymoon in cheaper markets. And you can bet, when the value is right again, history tells us they will be back for the profits.
Which really leaves us with one final question for you to think about. With the market down and the foreign money taking a little vacation, is this a moment to panic, or is this actually a moment of opportunity? Thanks for joining us for this explainer.